Get on board, get on track, get to where you're going. And now, your EduTrainer, national insurance columnist, Steve Savant.
Hello everyone, I'm Steve Savant, your EduTrainer and coach for the EduTrainment workshops on the entry level to life insurance. And today, all this week we've been doing series 11 through 16, and today's episode is measuring risk for life insurance. I'm going to do something very odd today that I think you're going to appreciate. But before I go any further, I just wanted to tell you that we're brought to you by Lincoln Benefit Life, an Allstate company. And what we want to encourage you to do is to go out to their site, lblsales.com/ETW, and go ahead to their Eclipse illustration software and download it. We voted it last year as the #1 user-friendly software, and for our educational purposes, it's excellent. So go back out to their site, www.lblsales.com/ETW, and go ahead and run the installer. Get this on, because in about a week or so, we're going to be actually using their software. So we want to encourage you to download it now and be ready so that you can go page by page on your computer as I'm showing you how this works. And they have an excellent piece of software. You're going to really enjoy it. And remember, we're still giving away our life insurance manual with vocabulary. All you have to do is ask for it at brokersalliance.com. Just write the biz, THEBIZ, at brokersalliance.com, and we'll be happy to send it to you. Well, today we're talking about measuring risk for life insurance. And oddly enough, I'm going to use something that usually is more for securities, but I'm trying to gauge the client's psychological needs. Sometimes the client isn't really ready to answer questions. He doesn't really know what his risk is. I need to run him through a gauntlet. Now, even though this is for more investment, I use it to kind of gauge the psychological profile of my client. Is my client conservative? Is my client kind of a moderate? Or is my client a risk? If I saw that my client was young and that they were risk takers, maybe even they're recreational, maybe they climb rock climbing or cliff, parachutes off cliffs, I want to be able to measure risk. What this will do is this will give me a little insight, and I'll say, based on your behaviors, based on your propensities, based on what you're doing, I may want to be more cautious and put more protection because I see the psychologicalness of my insured. Remember, knowing your client is everything. Well, here's an interesting start. Here's one. It says, which statement better describes you and your approach to life insurance right now? I have a budget for this, and I would like to know how much death benefit protection and cash value accumulation to be purchased, or I have specific death benefit need in mind, and I would like to know how much it will cost. Then you will assign a score to that score. And then my second question would be, which statement best describes your goals for both the death benefit and the cash value of your life insurance policy? First one says, I want death benefit protection for my loved ones in case something happens to me, but I would also like to accumulate some cash value on a tax-deferred basis to supplement my long-term savings. B would be, I want some additional life insurance coverage, but I am more interested in the tax advantages of building up cash value in my policy, including tax-deferred accumulation and tax-free access to my cash through withdrawals and loans. Or the third one, I want to increase wealth transfer to my heirs, and the income tax-free death benefit in my policy will help accomplish that. I may never take withdrawals or loans for my policy's cash values, but it's nice to know it's there. Notice that there's 3 different types of people, and they assign a numeric weight to this. It's gauging, it's a measurement, it's a way of assessing. A third one, the following is a hypothetical situation for a 45-year-old man buying a policy with $100,000 of death benefit. If you were this person, how would you most likely pay for the premiums in the first 20 years for this kind of life insurance policy? And what we do is we score it out and we say, I'd like to pay it over a 20-year period because I need cash flow and I am on a budget, so $1,600 is what I can afford. The total premiums will be $32,000. I could go ahead and pay it for 20 years, pay a little bit more, $2,100 is within my cash flow, and that would show me all my accumulation premiums would be $42,000. And then you keep going down to, finally you get down to this one where I'm willing to pay a one-time lump sum of $24,000, and I might pay that for 1 year, and I know that my cash value is going to be about $102,000 in 20 and a $78,000 cash value gain. I'm going to assign to see what kind of person this person is. Is he trying to pay the minimum, maybe you can pay a little bit more than the minimum, maybe a 4 pay, you just need to schedule it out over a short period of time, or they have the wherewithal to give me a single deposit. This helps me measure this, and again, it gives me a score. And my fourth question says, assume you have a large purchase to make in the next 15 years. Which describes how you would use the cash value in this policy? A, I'd first exhaust all other sources of money, personal savings, bank loans, so forth, before using cash value in a policy. Or, I would use the cash value in this policy via withdrawal or loan to pay for the entire amount. Or, I would use a combination of the policy's cash values and other sources. These are good questions that you're going through this gauntlet, this tree, so that you can make a determination. And it all actually opens your client up to their risk and what they're willing to do, and it gives you a good gauge. Number 5, withdrawals and unpaid loan balances will reduce the death benefit of your policy on a dollar-for-dollar basis. If you make a withdrawal or take out a loan, how does the corresponding reduction in your life insurance coverage make you feel? So if you did access policy loans, if you did access withdrawals, that's going to lower your death benefit. Is it acceptable? It's acceptable in most cases because access to my cash value is very important to me, or it's acceptable only on limited cases because preserving the full death benefit, that's important to me. Or third, I don't have a strong preference, it depends on the situation. And of course, you'll score those appropriately. Which statement describes the circumstances in which you would consider using cash value accumulations in your policy through withdrawals and loans? One would be, I'll only need the cash in case of emergency, medical or whatever, loss of job, and I'll only use it after I've used all other sources of savings. Or, I may need cash occasionally, once every 5 or 10 years, so I'll make use of some of the cash for major purchases like home improvements or tuition. Or third, I definitely intend to use most of the policy for some point in time, more than likely supplemental retirement income. This gives you a gauge of where the client's coming from, and that's why I like to go down these questions. Number 7, if you take a loan or withdrawal that requires you to pay income tax on the distribution, including a 10% penalty before 59.5, which describes your reaction to that? 1, I would want my financial representative to help me avoid this, if possible, because tax-free access to my cash value is very important to me. Or 2, this is acceptable because I'm mostly interested in my loved ones receiving a death benefit that's free from income tax. I also plan to make only a limited amount of withdrawals, and the cash value will have to accumulate on a tax-deferred basis. When you answer that, that's going to give that would give me a reason of seeing where I can come from. Is that 10% penalty? If that's something that I can do, and with life insurance, that is a major tax play that I can do. And if my client says that is a worthy goal, that could be important. Which best describes the death benefit pattern that meets your needs? I'd like the death benefit to remain the same regardless of how the cash value grows. That's be one option. I'd like the death benefit to increase as my cash value grows. There's another one. I would like my financial representative to help me choose the death benefit option that would most likely maximize my policy's cash value and in accumulation scenario. Or 3, I would like my financial representative to help me choose the death benefit option that would most likely maximize the income for tax-free death benefit to my loved ones. Notice that those are all weighted and they've given you a scorecard. Now, if you want to look at the psychological profile of this, you could kind of say, okay, you total their total numbers, and if the number lands between 18 and 26, you should select protection. This strategy provides a balance of life insurance protection and cash value growth when you want to protect your family members and begin building cash value over a long time. So if I see that number, that kind of tells me that's where I need to go. If I see numbers lower than that, between 9 and 17, then I say I have a different kind of opportunity, a select opportunity. In addition to the income tax death benefit, this strategy emphasizes tax-deferred cash buildup and accumulated by funding policies up to the IRS limits. This may be very well suited for if you're hoping to boost your potential retirement savings. Or if your numbers are from 0 to 8, you're at the lower end of the scale, The strategy is ideal when you want to use life insurance in an estate plan to increase the amount of potential income tax-free benefit to your loved ones. So what this does is it walks you through a gauntlet of questions so that you can come to the determination and say, this is basically your psychological profile that I've just asked you to go through, and you can kind of plot out where the client's coming from. Now, when I'm talking about protecting your spouse or protecting people, and I go from that, I now have a pretty good idea where the client is, and I want to know in my married couples or partnerships or business arrangements, I want to know, do I need to account for another person? If there's home, family, in our first week of sessions, we said, is it dual income raising kids? Is it dual income no kids? Is it single income no kids or single income raising kids? Are they dinks, dirks, sinks, or circs? Well, when I look at this, do I have a dual, if I'm married, am my wife working or she's not working? Am I not working, but she's working? I want to know, where is the income coming from? And I'm going to walk through basic ideas of spouse insurance. Remember, one of the key problems we've had lately, and I'm going to say in the last 5 years, is we still haven't graduated past our old cultural thinking. We always put on the female in a marriage situation as a rider. But now with most people working on both dad and mom working, they need to have equal size policies because both incomes are generally predicated, their mortgages are predicated on two incomes. So we probably steer away from riders now, and we give spouses, especially those who are working, their own policy so that we're not putting riders on it any longer. We're actually going ahead and writing complete separate policies on each mom and dad, and trying to make sure that the spouses are taken care of either way so that the survivors, their children, their grandchildren, their charities that depend on them, and especially, again, in business situations, if you have boss or employees that you have to take care of, or that you're just trying to indemnify your partner in case something happens to you. Now, when I'm looking at survivor needs analysis data, I want to make sure that I have all my scorecards down. I need to know the clients involved, who are the people that are going to be involved. If something happens to me, I want to write that down. I want to take all the dependents for all my children and all my grandchildren. I want to make sure I have all their information because remember, we're collecting data. And why are we collecting data again? We're measuring risk. We're trying to see how much we can afford, how many people are dependent on us. Can I do a little bit more than I thought I could do for my survivors? Or no, this is what I have, this is all my budget allows. I need to know that, and what I do is I collect the information on a family. I'm gonna get mom and dad, I'm gonna put them on this data collector, and I'm gonna list all their dependents, their children and grandchildren, and then I'm gonna list schools. What schools do they go to? What schools do they wanna go to? I wanna be able to measure this, and I wanna be able to start looking at basic ideas, income needs. Beginning today, if death occurred, what do I need on a monthly basis? I want to be able to know what percentage of that is in my current income. I also want to know, beginning when the youngest child reaches 18, what am I going to need to take care of those children? And this has nothing to do with college yet. We're just talking about expense loads and paying the bills. And beginning at retirement, I need to know what kind of monthly benefit that I'm going to need. So remember, I already asked those questions early on in our episode today. I went through all that. I pretty much have an idea where the client's coming from. Now I'm putting the psychological need of my client that I've kind of put a numeric number to, and I'm trying to assign now real numbers to this worksheet. Then I look at income sources. Annual employment from my income. Maybe I'm getting interest income. Maybe I'm getting inheritance income. Maybe I have investments that are generating income for me. I want to get my monthly Social Security benefits, what I think they're going to be, and then list any other sources that I have on this sheet. Because all I'm trying to do is basically lay out a survivorship needs data. And that capital and debt and all the assumptions are written on this page. Again, we're giving those away. Absolutely, just write me at thebiz@brokersalliance.com and we'll send it to you. I'm going to go through all the assumptions of mortality. I'm going to plot when I think client 1 and client 2 are going to die, and then try to use annual inflation and plug in numbers on my worksheet so I can get a pretty good estimation, a pretty good guess of what I'm going to need. And again, we have all those mortality tables written inside our life manual. That's what we have today for measuring risk for life insurance.
This has been an EduTrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.